Rahim, today, as an advisor, when you meet with employers, there's so many different types of people that are in the population of our plan members today. They're not the same as they were 20 years ago. Different demographics, different generations, people new to Canada. I feel like the guest that's coming in today is going to really help us understand some great strategies to help develop financial wellness for Canadians. So, what are you hoping to get out of today?
You know what? I'm excited to have Brady come on. Anecdotally, I'll tell you, one of my earliest jobs in the group retirement industry was in financial education. And I used to go out there and educate plan members of plan sponsors. And the types of questions I used to get and who those questions are coming from is materially different versus what I see today. And that's that demographic piece that we will expand on. So I'm looking forward to that. Also, Brady and his team are doing a terrific job with respect to products and trying to be innovative in a very traditional industry, which is a refreshing to see. So looking forward to our conversation with Brady.
Awesome. Well, let's get him in here. Brady, welcome. Brady Aarssen from Canada Life. Tell us about yourself, your background, and why you got in this business.
Well, the last one's probably the tougher one, Caroline, but it's great to be here. So Brady Aarssen, I'm currently leading our group retirement operation at Canada Life. I also have this distinct other little title called Innovation. I think we'll probably dig into some of that today. Been in that role for about 2 years. Previous to that, I led our strategy team in the group division for about 6 years. Previous to that, I was leading a field office for Southern Ontario. Also have worked in the benefit space, including some time at Green Shield, and really got into this industry haphazardly, as many people do, but it's been a really fun place to be. I haven't thought once about going anywhere else. So it's been great to diversify my experience and knowledge, benefits, retirement, and other products. And so there's lots to learn and lots of cool stuff going on.
Awesome. We'll have to compare notes as to how we all landed in this business for a future episode, because I'm sure we have some good stories.
That could be its own podcast.
Yeah. But we'll stick to this one to begin with. Let's start off by talking to us a bit about what was the employee makeup 20 years ago, and when it comes to demographics, looking at group retirement plans, and where we are today, and just some of those nuggets of what you're seeing as to what that means.
Yeah, well, it's very interesting. I think about my time in the industry. I started in 2008, so during the great financial crisis, and every meeting, every conference you went to, all you heard about was the baby boom population. It was this large cohort coming through the working age population, and it's like, oh, well, you've got to attract and retain baby boomers. You've got to plan for retirement. You've got to think about topics that are still being talked about today, like decumulation. And so that was the big prominent population. And then there was this upstart population of millennials, and, they're digital natives and they're more in favor of technology, and you've got to appeal to them, and they've got some different needs. And that was always the rhetoric that we heard, when I started in the industry. It was, baby boomers versus millennials. And it was this real focus on retirement and decumulation. What's happened since then, and in fact, I'd say quite recently, like in the last 2 or 3 years, and as we kind of come out of this post-COVID era, I think we've lost sight of this to some degree, is the baby boomers are gone. The youngest baby boomers are, depending on your data, have turned 65 or are turning 65 in the next year or two, and have largely exited the workforce. And the fear, I remember from those conferences 15 years ago was, oh my God, how are we going to replace all these baby boomers in the working age population? We're going to lose all this talent and this knowledge. And this is going to be a crisis. It's going to impact our tax base and our ability to pay for infrastructure and public services in Canada. But ironically, and it's had some negative consequences, we've largely been able to avoid that because the millennial population has swollen now to be the largest population of working age Canadians.
Could you define millennials for us?
Yeah, so millennials, the definition varies, but I would say let's call it like 1980 birth dates to about 1995 to
almost
2000.
a millennial.
I've seen lots of different dates that are chosen, but it's somewhere in that framework, right? That 80 to 95, somewhere in there. I've seen 82 to 2000, lots of different things. But they're now about 28% of the population of working age Canadians. And so that's the biggest single cohort. And so they're a unique population. They're a big population, the biggest since the baby boom. And so they're kind of filling a bunch of those gaps better than expected. But more prominently, and a real consideration for advisors, plan sponsors, people thinking about how to appeal to this population, is the growth of new Canadians. So many would know, last year was the largest single population growth year in Canadian history. Depending on how you measure it, we had 1.2 to 1.4 million Canadians come to Canada last year in 2023. And that is a massive number. And they are primarily working age people. And so that influx into our population has stemmed some of that baby boom fear. It's also created a ton of demand. We saw in 2022, 2023, the demand for labor and talent and these kind of talent wars. And, that's now we've got all these people coming in, all these different skill sets, and there's kind of this panic to grab people and hang on to people. And so it's really changed the makeup and the diversity of the workforce, because you've got this big population that's actually kind of in their sandwich generation years. And then you've got all these new Canadians who don't know anything about our products or our financial system in general. And you're trying to serve them, because in many ways, the baby boom population has kind of left the building at this point.
So is that something you could have modeled for?
I don't think we could have modeled for the new Canadians, because that's really, I'd say that's federal government policy. And I don't know that anyone was anticipating that we would see that degree of growth. I mean, certainly put in context, the pre-Trudeau government era, you would have seen population growth of around 250,000.
Right. 4x that number.
To 300,000. And so the fact that almost 5x that number, depending on how you measure it, I don't think we could have anticipated. And so that really changed the dynamic. And I think it's a real, I caveat this, a real issue is probably not the right word, a real challenge for us to kind of navigate through now as an industry. How do we educate that population? How do we engage them? How do we get them part of plans and support their entry into Canada, so that we don't have a bunch of people 20 years from now saying, I've got inadequate savings, my employer, the financial system failed me, no one supported me in those early years. That's a real risk if we don't get that population right.
Yeah, I just to add from my experience at Penmore Benefits, where I work out of, I would say 2023 was a year where I have not implemented so many brand new plans for my entire career, right? It was an unusual year where it was week after week, net new companies created. A lot of those companies employed people that were foreign. And, as you know, people that come to Canada in their year zero, you can't even put them in an RSP because they have no earned income. Companies don't want to put in a pension plan. So you have these new people, net new to a country. Clients are trying to help them solve for getting them a head start with retirement. And there's not much you can do except a non-registered account or something like that. So, I'm wondering from a products perspective, where is the industry heading?
Well, good question. I'd say, we've got a bit of a marketing and education problem as an industry. It's not, I would say, if we remain exclusively focused on retirement, we're going to lose the interest of a lot of the population. We've got to diversify that product set. And so you think about these people, to your point, new Canadian, year zero, non-registered, that's a challenge. We got to get over that challenge. 2, education. They don't know anything about the products themselves. So what are the products? How do they help me? How would I use them based on my situation? Think about it this way, like they've had zero education up to, let's say they're 30, 35 years old, coming to the country and go, okay, well, what is all this stuff? What am I supposed to do? So education's a big one. But again, picking on that population we talked earlier, the millennials being this biggest cohort, that millennial generation, we hear about the challenges in Canada of home ownership. So how are you supporting them to save that down payment for a home? If you've got a group retirement plan, and you've got locked in money, particularly on the pension side, well, that's of no value or use to that population.
Which is so perplexing.
And they go, well, how's this helping me? And so what do? They often don't participate in the plan. So they're missing out on employer match. They're deferring retirement opportunities. So that's a problem. 2, people generally are having kids a little bit later. And so that same population is kind of, they've got 5, 6, 7, 10-year-old kids at home, and they're thinking about saving for education. We know how much the education system cost has swollen over the last number of years. I mean, when I got a degree, it was, $3,000 or $4,000 a year, and now it's like 10, 12, 20, 30, depending on the program. But I would say it's, so like saving for education, having an emergency fund, like we think about, I think what a lot of people, Canadians and new Canadians, learned in the pandemic was, oh geez, the world's a little more volatile than I'm used to, and maybe I'm not as prepared as I should be financially, and I need to get my financial house in order. Another huge one is debt. Canadians, other than Australians, are kind of globally regarded as, we just love our debt, and we accumulate a ton of
we
debt.
inflate it away.
Yeah, well, that's always an option.
We got too comfortable.
But I would say debt management strategies. So again, that's a radical idea for a group retirement plan. Like, hey, we're talking about retirement, but now we're talking about debt and debt management.
So can you expand on that? It's a traditional group retirement program, would offer matching, plan member contributes their component, employer matches. So you're kind of turning that on its head a little bit. Is that what you propose?
Well, what I would suggest is a possibility. It's maybe a more organic transition from that. Is the mechanics of that are fine. A member contribution and a sponsor match. That mechanics, I think, we can leverage. But how I would change that, and so some of the things we've done at Canada Life recently is imagine an environment where you say, okay, member match to the financial need of interest to that member. Sponsor match goes to a retirement vehicle. And so we have a couple products that, we've launched in the last few years. One is our student debt product. So, you're a new graduate, you're coming out of school, you got $30,000, $40,000, $50,000 of debt. That's going to hang over your head for a while. You're going to want to pay down that debt. What we were seeing is, particularly in that under 30 population, their participation rates in retirement plans had dropped by 15, 20% from the prior generations. And we went, okay, well, that's a problem. We want them participating.
So is that directly, you think, an affordability issue?
I think it's an affordability issue. It's a debt management issue, again, kind of back to that category. And so they've said, or we've said, okay, how about if we created a facility through which every dollar you donate to your debt repayment, your employer will match in a retirement vehicle. And so concurrently, you're now managing and paying down your debt, not losing out on your employer match, starting that journey on the retirement side, albeit on just the employer match initially. And once the debt is gone, you've created disciplined habits around savings,
right?
That you then will, transition back over to the retirement vehicle. And now you're kind of good. You've built that habitual behavior, right? So that's an example where it's like, okay, well, we could pay down some debt while also contributing to retirement. And then later, you've built in that habit, and that habitual forming is almost as important, right? In terms of getting people used to saving, used to that discipline and that behavior. So that's one example of what we've done recently.
So I'm going to make an observation as a plan member. So I was not born in the 80s. I was in high school in the 80s. If I was a millennial, to me, that would feel like an employer has built a program that suits my needs. I mean, I'm spelling it right out here, right? Before I was paying $100 to my student debt and nothing was happening at my company. Tomorrow, in this product you just described, $100, I'm paying my debt, but you're putting money away for my retirement, $100 in the retirement account. How great is that? To me, that speaks to the value, like I feel valued by my employer. And from an employer standpoint, you are winning the war for talent. And that's the problem we talked about earlier, right? To say there's so many people, whether it's new to Canada and the millennials, you need that war for talent. So let's build on that. What else have you got?
We've done this dichotomy of 20 years ago versus now. So, like one interesting contrast that we could draw from that is since the year 2000, there's only been 2 new defined benefit plans in Canada. 2.
Wow.
So when you think about it, what is a defined benefit plan? A defined benefit plan is a one-size-fits-all retirement vehicle for a population that you anticipate to be a tenured population that will stay at that employer for a long time and is looking for retirement security. So that's a one-size-fits-all kind of monolithic plan structure.
And it worked well back in the day, right?
It worked great.
My dad had that. He worked there for 30 years, 40 years.
And you know what? In a lot of public sector contexts, it still works great today. Lots of public sector employees are benefactors of that, but certainly the private sector is not seeing that. So So you've got these monolithic one-size-fits-all plans, and that historically has been what a retirement plan is. Now I would say we're moving to what I would call a more dynamic, modular type of plan that becomes more individual to the plan member. So to your point, Rahim, you and I could all be on the same plan, and you might be partaking in the student debt repayment program. Rahim and I don't need to. In fact, Rahim might be participating in another new product that we launched recently, which is a group RESP. And to my knowledge, I think Canada Life's the only one who offers a group RESP. But there's another example where my need as a member may actually be more around saving for my kids' education. So, by contrast, Caroline, I'd say Rahim could be in the same plan, and he's sitting there going, hey, I got a 3-year-old, a 5-year-old that my priority is saving for my kids' education, and I want to contribute to an RESP. And so maybe I won't join the group retirement plan, and I'll start my own individual RESP. So, again, we were hearing feedback like that from members as we do different member surveys. And it's like, okay, well, what if we designed a product that let Rahim contribute to the RSP, still get a match from their employer, still start building that nest egg for retirement? And then you come to me, I might be in the same plan as both of you. And I'm sitting there going, actually, you know what? I don't have kids. I don't have any student debt, but my priority is to save for a house. And so, what options are there for me? And luckily there's a few options. I could look at, the government just recently announced increasing the RSP home buyer's loan. Maybe I want to contribute to an RSP and know that I can tap into $60,000 there. Maybe I want to do it in a TFSA, a non-registered account, a first home savings account. So there's different vehicles, right, that are available. And I think what you'll see as our industry evolves over the next few years is, and we have been doing this, like this isn't, all instantaneous, but that movement, that journey from the monolithic DB plan of the past to these modular, more dynamic plans that are catered to a population with a whole bunch of different product types that ensure, like the ultimate goal behaviorally is you want participation. So if you can get 100% plan participation as an employer or as an advisor, you've won. That's great. So what are the barriers to you getting that 100% plan participation? I would say product selection and that more modular environment is probably the barrier number one. And then barrier number two is education. So making sure that the members understand, hey, you know what are your goals? We have a solution for you. We have a product set for you that's going to allow you to participate, that's going to give you that employer match. And again, like if we zoom out and think about the macro environment in Canada, our cost of living in Canada is high. We've experienced our first kind of bout of real inflation in about 30 years. And so you go, okay, people are worried about cost of living, affordability, savings. Well, one of the things that you really don't want to miss out on in an environment like this is a free employer match. And we see far too many people not participating in plans because their perception is that it is still that monolithic retirement vehicle, and their priority at 25 with student debt, 30 trying to buy your first house, at 35 with young kids, or 40 is not retirement at this point in time. It will be, but geez, we all know the benefit of time-bound savings. Like, let's get them involved. Let's build those habits, those behaviors. So education's the next barrier, but creating a more modular dynamic plan is barrier one.
Yeah.
So Brady, maybe a tough one for you here to answer, but I'll put you on the spot. Hopefully that's okay. As an industry, we've had so much focus on fees and scale, right? The bigger the plan, the lower the fees. And as much as I love your solution of one person putting their money away towards their school repayment, which is not a part of the plan, contributions, another one saving for home, which is also not a part of the
or will be, but then withdrawn.
Yeah. Or will be then withdrawn. Exactly. Yep. So like the carriers and industry as a whole has to play ball, because it would be unfortunate if you have 100 life company and 20 people are doing that type of an arrangement. The other 80 won't have enough scale as they would have if all assets are going in the plan. And we've ingrained into people's psyche that low investment management fees, if all else is equal, really drive home returns. So how do you solve for that, or like what's going to have to happen for that?
It's actually, so you're absolutely right. I think the fee conversation, we can thank a few prominent fintechs in Canada for that. all things being equal, I think, one, again, education, because typically performance isn't equal. So, you want to think
agreed.
about performance relative to fees. But we know that as a carrier. And in fact, it's kind of interesting. My role now is running the operation. And the second part of my title is innovation. And one of the big things that's been on our priority list as a carrier, and I'm proud to say is kind of in motion for Canada Life, has been how do we drive our cost of operations lower so that we can keep fees lower despite seeing volume of assets maybe a little more variable in a dynamic environment. So the big things, like if you're looking for insights into the belly of the beast of an insurance company, we're installing a lot of RPA, so robotic process automation. Historically, when we would get withdrawal requests from plan members, those were actually like a human being would take the withdrawal request, log into the system, check their account, issue a check. We've been on a journey to kind of move past that. And really the goal is to get to a fully automated straight through processing sort of environment where, hey, I come on that particular insurance company's web experience and I'm able to request a withdrawal and no human interaction. It goes straight through. That drives costs lower, drives fees lower. Other things that we're looking at is more dynamic intake and workflow systems and tools. And we could, kind of nerd out on some of those if you want to go there. But, basically systems that allow us to have technology, reading PDFs, reading emails, etc.
Yeah, we have to, as an industry, go there.
And frankly, it probably should have happened already by now. Like it's a bit of a condemnation on us that we're just getting to it now. But I'm pleased to say that we are getting to it now. It is real. It is happening. In my organization right now, we are literally launching all of these types of tools as we speak. And that's driving down our cost of production, which is going to allow us to keep fees competitive. Because you're right. It is going to be a more variable environment in terms of contributions and assets. But the other thing I'd probably add, and this goes back to the demographic trends, right? I think about, my parents' generation and we think about life expectancy. There's that longevity risk now that's existing where we say, hey, wait a second, people are living 5, 10, 15, 20 years longer. And when you look at millennials in particular, if we pick on them again, and then certainly, Gen Z and Gen Alpha after that, the younger generations coming behind them, like they've got really good shots of living to 100 years old. Their probability of getting there is much higher, like to the sense that I think actually I saw a report recently saying, the expected life expectancy is in the low 90s.
Of someone born today.
For a millennial.
For a millennial.
So, like 90, 91. And so you sit there and go, okay, and then Gen Z and Alpha, they have a shot at triple digits.
Right.
So a couple things to think about there would be, while the contributions might be more variable at the front end, the longevity of their career might be longer on the back end.
Right.
And so their contribution window over time is probably bigger as well. Like again, drawing on that parallel from 20 years ago, the DB plan, a lot of DB plans had 25-year vesting or 30-year vesting schedules. So, you come out of high school or college or university, you're in your early 20s. You hit your 30-year vesting schedule at 55. Of course, our organization is famous for Freedom 55 branding and marketing campaigns. That was a big part of that, was like, hey, if you've got a DB plan, you're probably fully vested at 55 and you can leave, and your life expectancy is probably in the 70s. So like, go enjoy your retirement and go enjoy the fruits of your labor. By contrast, I go, millennials, Gen Z, we're seeing much higher, volatility of career. They're going to have 8, 9, 10 jobs, the gig economy, more contracting type jobs, but the longevity risk is much bigger. And so we anticipate that likely, they're not there yet, but likely their contribution window is going to go longer as well. Like they will probably work to 70, where their parents may have worked to 55 or 60.
Yeah.
And so some of that catch-up time on contributions and assets, I think will be there. It's hard to say.
And they'll have the advantage of compounding as well. So
they'll be able to compound into that longer window.
So I've got an observation on that too. So when it makes it more important than ever that in that sort of triple threat plan design we just talked about, that people get in that to get the matching on the employer side. Because if that needs to be there, because if life is longer, you have to start saving earlier to fund that longer life. So education, let's bring it back to the importance of education to get people in one of those plans.
If you're an
and get
employee
savings.
listening to this, like the biggest takeaway is make sure you're getting your employer match in whatever variety of plan you have access to on the first day that you are employed with them. And anytime you change employers, make sure you're immediately getting that match again, because that's really the key. It's, Rahim talked about, it's the compound effect of getting access to this free money. And I think people are, financial literacy has gone up through the pandemic because we had a little more time on our hands to look at financial markets. And there's a lot more financial education available on YouTube and Spotify and places like that.
I thought it had to do with our podcast.
Or maybe a podcast. But I would say, like, getting access to that match is so critical. And that's probably takeaway number one for an employee. For an employer, if we were to shift gears, like if you're an employer and you have employees, my number one takeaway for you from this podcast is to set up a plan. Rahim talked about he set up more plans than ever. We're seeing that too. There's a lot of growth, particularly of new plans. So we would call those, no asset, all cash flow plans. And those are great because, that's going to distinguish you in the market competitively. Like we look at, so obviously we're the largest benefit provider in Canada, and we have really good access to that data. And you would see, in that data, something that I think would surprise a few people, the likelihood of an employer to offer a benefit plan is 3 or 4 times more likely than having a retirement plan. So if you looked at our entire benefit book of business, we would say only about 30% of those employers offer a retirement plan. So if you're thinking about war for talent and attracting talent, retaining talent, all the benefits of having different programs, if you're an employer listening to this, 70% of your competitors don't offer a plan. And so when you're out there trying to get talent, recruiting at universities, trade schools, whatever your business might be, you offer some type of savings program, retirement program, you've got a 70% advantage in the marketplace. And that's actually, frankly, as time goes on, those numbers need to change. Like if you're an advisor listening to this podcast, I would say setting up more retirement savings plans and not just exclusively focusing on benefits, having that diversity is really important as well.
And Brady, we talk about education, and our brain leads us to plan member education. And so often, even the business owner and the employer need education. So one of the reasons behind why an employer may not offer that we hear all the time is, my employees barely have any discretionary income. If I'm going to give them $1, I want to pay that dollar in salary. And then when we work backwards, we tell them that's probably the least tax efficient way for you to pay them. You're paying them as salary. They're paying income tax. You really want to help them in an environment where there's no taxes and there's compounding. So us as advisors, and I know it's a very simple thing to say, and we all know this example, but I think educating the plan sponsor as to, even if they have the dollars to allocate, how important it is to consider where that dollar goes, whether in a group retirement plan or in salary, because you may think you're doing them a favor, but you're not. Are you seeing some of that on your end?
Yeah, you're absolutely right that is one of the challenges. But to your earlier point on the growth of these new plans, what we're seeing a lot of employers do is say something like, hey, you know what? We do an annual pay review every year. And in lieu of giving an increase this year, we're actually going to set up a group retirement plan. So where we may have given everyone a 2% increase, we're actually going to give you a 2% match in the new retirement or savings program. So that's a popular way of doing it. I mean, some of the other ways you can do it is obviously in a DPSP. If you want to set some organizational goals around growth or profitability within your business, you can say, hey, we're going to set up a DPSP and we're all in this together. Let's grow our business together. And if we grow, we're going to make contributions to our employees in that way. So there's creative ways to do it. I think to your point, it's more about the education, because I think the stock response of, my employees don't have any discretionary income, and if I'm going to give them $1, I'll give it to them as salary. Once you start getting a little more creative and say, well, what if we grew your business by 10%?
Right.
And you had a DPSP and your employees got to participate in that. That seems like a pretty engaging way to get your employees motivated, not just to save, but to drive your business growth.
We have a client that has KPIs, and based on, how those KPIs get hit, there's a reward system that goes into a DPSP or in a in an RCA account. So they do work, those incentives.
Hey guys, I gotta check in here. All these acronyms flying around. Talk to me.
DPSP is a deferred profit sharing arrangement, savings plan, and then RCA is a retirement compensation arrangement. So that is a plan for executives. But I think the point here is, if you do provide an incentive, employees do work and they want to meet those goals so they can get their reward. So everybody wins in an environment like that.
Awesome.
Yeah, so that one to me is one where I go, what's the downside of doing something like that, right? If you grow the top line of your business by 10 or 15% and you're kicking 2% back to the employees through a DPSP or 3%, 4%, whatever you choose to do, that's pretty cool. I'd say too, like the one last point on that is, and Caroline, you just cued me with your, hey, acronyms, what the hell's going on? Of course, we love acronyms in the financial industry, but I would say the value of advice is more important than ever, because you can tell as we talk about this stuff, it's more complex than ever, the environment. And so, again, when I'm, whether you're an employee, an employer, working with an advisor to understand this stuff, to understand what your options are. Because, again, the solution you just described, Rahim, I sit there and go, yeah, but like, how many employers know about that solution? How many employees maybe feel courageous enough to go to their employer and say, hey, listen, how do we grow the business? And if we do, I'd love to get access to a retirement plan. And so, just educating, advice, find a good advisor, get advice. It is complex. There is a lot of acronyms, but it's so important that you get that advice so that you get access to these things. And so that's a big takeaway for me as well.
One other part, I love what you just described of like, instead of doing the salary increase, why not switch and do the 2% matching? Got to learn from past, change management and education. There's going to be half the population in the membership, particularly the millennials, new to Canada. Okay, I'm not getting a raise. Not only how do I understand what the benefit, like what's in it for me, but going home and explaining it to my spouse or my family, like, nope, didn't get a raise this year, but there's some good thing that's supposed to be good for me. Like, it's critical, right? Because you could have the best plan that is so customized with that. I like to call it the triple threat plan now. But if people don't understand it, they're going to be very leery about it and want to say, okay, my paycheck, my take-home pay did not change for the whole year, but tell me how this is good for me.
So in most new enrollment sessions where you are taking an employee through enrollment, there's a slide that all carriers have, all consultants have built into their enrollment deck. And the slide articulates on one column your income. And if you did not make an RSP contribution, what would be your take-home pay? So it's simple math based on your tax bracket. And the next portion, so the column right beside that, says, if your take-home pay is this and you're making a 2% contribution in your RSP, that money goes into the plan before taxes are taken out. And what is a change to your take-home pay? And what that example is able to articulate is that you lose very little. And if you add the employer match on top of that, you may be missing $40 in take-home pay, but your RSP has $100 going in. Right. And then other slide talks about compounding of that $100 over the next 20 years. So when you give numerical or proper examples for employees, it resonates. Numbers are the same in Indian languages or Latin American languages. So if you show people the math, it resonates, because if you could keep $1 rather than giving it to the government, you'd probably appreciate it.
It does. And it sounds like maybe you just need to add maybe 3 more slides to replicate that, right? For the student and for the home buyer and the education saver and the RSP saver, that slide needs to be shown for everyone in the room, right?
Yeah, I mean, so this is a popularized consultant term is that they like to say all the time is, well, net. What does this mean? And I would say that's really what that kind of slide is trying to get to. And you're right, you could cater it to different populations, different examples, different tax brackets. A contribution to a savings or retirement vehicle is going to net you more money as an employee than it would if you were getting in a salary.
Yeah.
I mean, income tax, CPP just went up this year, payroll taxes for the employer. I mean, like, you look at it and go, Yeah, net, this is like tax sheltering. It's not tax forever, as we all know, but it's tax sheltering. It's that you get the full value of that dollar to grow and compound over time, or to pay down debt and avoid those interest compounding in the negative sense. So it really is about that education and saying, net, this is better for you in terms of where you're going to end up as an employee. Of course, it requires education, because if you don't have that education, people do go home and they start to create their own narratives about, like, is this actually good for me, or am I getting screwed over, or what's going on? So it is important that you get in front of it.
My last question for you, Brady, or I probably will think of another one, but I'll stick to this one, is you talked about how there's 3 to 4 times more plans that are group benefits as compared to group retirement. And I'm very happy to hear from both of you that that is on the rise. Like, there's a lot more new plans coming in. From the employer standpoint, let's consider how their costs are projected for a group benefits plan compared to a group retirement plan, and what that means. Because I think there's some pretty interesting observations that you might have on that too.
Yeah, well, interestingly, if we use the case study of the defined benefit plan and group retirement, I'll go back to that for a second just to create a proxy. So in that world, part of why employers got away from the defined benefit program on the retirement side is that, it's having to be constantly reviewed to measure the contributions, and things like inflation risk and longevity risk. And this is where actuaries make all their money, is doing these calculations to say, well, how much money do I need to be contributing to this defined benefit plan to cover the liabilities of the population in the future? And the answer is more, generally. It was very rarely less. And so employers went, geez, this is really volatile. I like defined contribution. I like group RSP. I like group TFSA, et cetera. Ironically, benefits is where retirement was. That's where they are right now. A benefit program is largely a defined benefit program. Now, there's certain components of a benefit program that have defined contribution, your healthcare spending accounts and things like that. But the real risk, whether it's drug or out of country or, life or disability, those big risks are defined benefit. You pay a premium, there's a risk that there's a claim. And I think what we're seeing, and it's nobody's fault, like no one person's fault, but like what we're seeing is, particularly in the environment we're in now, high inflation, high interest rates, population growth, et cetera, like those benefit plans are becoming harder and harder to pay for and manage because their costs are going up 10, 11, 12, 13, 14% a year.
And they're volatile,
and they're
depending.
Very volatile.
Yeah.
And, they can go down. They often don't, but they usually go up. In a group retirement plan, what's nice is for both the employee and the employer, it's set at a set percentage and it doesn't change, right? Hey, we're doing X in percent or dollars. Some can do it in dollars, percent or dollars. And that's what we're contributing. That's what we're committing to.
Yeah.
And so from a budgeting perspective, whether it's employee or employer, because many benefit plans, remember, have employee cost sharing too, right? And employers are going, hey, what the heck? I just got an extra 20% taken off my paycheck. Yeah, sorry, that was to pay for the increase in the benefit plan. So the retirement space has made that transition almost fully to defined contribution, where it's a set contribution, and then it's up to your investment performance to drive your return. The benefit industry is still very much defined benefit, largely, not entirely, where it's a set premium, and the premium will adjust to risk annually. And the adjustment is up, generally, not always, but generally. And certainly in an environment like we're in now, where we have high inflation, it's up. And so it's a little tougher to manage, still hugely valuable, but tougher to manage than a retirement plan. It's going to have more volatility for sure.
Something very important to take back for our employer audience, right?
The CFO, when they're setting up their retirement plan, can pinpoint their cost on the high end to the penny if it's based on salary. So yeah, more fixed for sure.
Anything else you would have to add, Brady, before we wind things up today?
Maybe a quick tangent off of what we just talked about, and then interested in Rahim's thoughts as well. I would say, another thing to evaluate when you think about Canada, because public policy is changing so much in the country. We hear things like national pharmacare, national dental care, et cetera, is, whether you're an employer, employee, or advisor, thinking about it kind of goes back to that pitch of, I'd love to see that, 30% of plans have both benefits and retirement. Love to see that number grow. Is when you think about your risk and risk management, that's a big part of what we do as an insurance company or as advisors, is managing risk. And, on the healthcare side, the benefit side, the social safety net is growing in Canada. So in terms of support for health and dental and those types of expenses. Now, that doesn't mean you shouldn't have a benefit plan. You absolutely should. But, there's a growth of social safety net there. Conversely, on the retirement side, it feels like it's almost going in the other direction. I mean, there's lots of concern about the stability of the CPP, access to OAS. You look at some of the retirement vehicles and you start thinking like, ooh, are these really keeping up with inflation in terms of contribution limits and things like that? And so from a risk perspective, I would say there's more risk, if you're 30 years old as an employee or you're an employer with 10 or 15 people, there's more risk that your people or you individually will not be prepared for retirement or be able to have the retirement you might imagine with a proper income replacement ratio than there is that you're going to have access to the necessary healthcare or dental care that you might have. So thinking about it from a risk perspective too, like I know we just talked about the actual funding of it, the financial impact, but there's also a risk thing there where you go, is there more, like, does our government, does our social safety net as Canadians protect us more on the health side or more on the retirement side? It's an interesting question. I invite people to do their own research. It is unique, obviously, based on your own individual circumstance, your assets, your income tax bracket, et cetera. But that would be an interesting thing to think about. And then the last thing is, and I joked about this with both of you before we started today, we've got a bit of a marketing problem in the group retirement space because I would love it to not be called group retirement. I haven't come up with anything better. Financial wellness program, group savings program. There's probably other great ideas. So,
Triple threat program.
if somebody's got a great marketing term that we can, sell the sizzle a little bit more to employers.
Health and wealth, right?
Health and wealth. I like
there
that
you
too.
go.
I think to echo what you were saying, Brady, the same thing. It needs to be treated in the same light.
Yeah.
So when we meet with plan sponsors who are thinking of putting in a plan, we show them that 60 to 70% replacement ratio. So if you have a plan member that's making $100,000 a year, they would need 60 to 70% in retirement to maintain their standard of living. We back out CPP and old age security. You still need $55K a year. And Brady's telling us, with health leading us to live longer, how is the average individual going to be able to come up with $50,000 a year times 25 years in retirement,
adjusted,
plus inflation adjusted? We don't have investment products that guarantee inflation protection or not well utilized. So it is a concept that really needs to be driven home. And hopefully one day it's a given that a company offers health and wealth, and business owners are thinking that I have to do this because if my employees worry about their financial future at my job, they're not going to be healthy. That's going to lead to more costs. So these plans, they work in unison.
I would leave it there. I that's a great summary. I mean, the only other thing, that we've talked about a lot is just, really emphasizing education and advice. This stuff isn't easy. And I know there's acronyms and it's confusing. Don't use that as an excuse to not do something, to not take action here. That the advice is out there, seek it out, and try to build your education around these things, because there are solutions to many of these problems, not as well utilized as we'd like, but we think that they're on the rise, which is positive. And so continue to pursue education and good advice. And, I think you'll have a great shot at getting that 60 or 70% replacement ratio, staying healthy, because, the benefit plan is still a critical part. Staying healthy so you get to retirement, staying healthy in retirement, because at the end of the day, we all want to live long, fulfilling, healthy lives. And, your health and wealth are part of that.
Exactly. And I think today we've solved, or partially solved at least, a lot of the pressure points or problems, right? So number one, there's a war for talent. You've given the solution to an employer to put in a very customized feeling plan that's going to help everyone, not only today for living their life and what they need and putting their funds towards that, but the employer saving for the future for you while you live your life and do that. So a lot of great wins for the employer in an affordable, fixed cost way, meets the needs of your plan members, attracts and retains talent, and gets you to your health and wealth.
Awesome.
Thank you for coming and having this dynamic conversation, educating us, and Rahim keeping us on point too, thinking about plan sponsors and plan members and how we all bring this together.
Thanks for having me. It was great.
Thanks, Brady.
This has been the Benefits Alliance Voice. If you enjoyed today's episode and learned something, please share it with your network.